Good morning, you magnificent melon heads. Happy Inflation Day, everybody. It is 8:15 a.m. Eastern Time. We are just 15 minutes away from the Consumer Price Index for the month of November. You're going to find out just how much more difficult our lives got in the month of November. Right now, it looks like markets are expecting a 7.3% headline year-over-year number and 0.3% month-over-month, with a core inflation, which strips out food and energy, which are known to be volatile, expected to come in at 6.1% year-over-year and also 0.3 month-over-month. All right, so those are the market expectations. If we get higher than that, market will probably head lower, expecting a more aggressive Fed. If we get lower than that, markets will likely go higher, expecting a less aggressive Fed. That's kind of how things have been going for these last few years. Now, I don't like to trade around CPIs. We tend to get some big wild moves in the immediate aftermath of a consumer price index release. And then sometimes, inexplicably, those moves can suddenly reverse and go right back the other way. So I tend to set my trades ahead of time, and then I just back up and I watch, and I don't make any moves based on that. And that's besides the fact that tomorrow we have the FOMC and Jerome Powell and his press conference, something we will be going live. Also, I believe that starts at 2:15 will be our live stream tomorrow for the FOMC press conference. So we will be here for that. Please like and subscribe while you're here so you don't miss that one. And we are going to bring my man, Mish, the mod, in. Mish, how we doing today?
I'm doing great. I'd like to say whoever came up with the fruitcake flavor for Mountain Dew should be shot in the face and then drawn and quartered.
Yeah, Mountain Dew, just bad form. I like how your green screen cuts out the Mountain Dew, by the way. That's nice.
Yeah, no, exactly.
Yeah,
It's
yeah,
so
that
bad.
stuff's that's radioactive horse piss any way you look at it. Sorry, folks. Sorry to any Mountain Dew fans out there, but that's one sponsorship I will never accept on this channel is Mountain Dew. It's just bad form. All right, everybody, let's take a look at what is going on in the markets. What you're looking at right here on the screen with this tiny, tiny print. This is bls.gov/CPI. This is the website where the consumer pricing index will be released. I'm going to zoom in a little bit for you here. And then down here on the right is where we'll see it. It's still showing the October readings, which are the readings from last month. Just a quick review. Last month, CPI came in at 7.7% year-over-year headline. That's this number in the report from last month. And 0.4% month-over-month. All right, so we are seeing inflation is coming down a little bit. The question is it coming down enough to get the Fed to take some of the pressure off of the economy? We will see. And I got to send a shout out to my friend, Jose Orozco. Thank you, Jose. He says, for go-go juice, good morning. That's right. I got my wake-up juice right here. It is 8:15 a.m. It's a little early for me. I don't usually do these early hours. Says, good morning and happy SBF arrest. Yes. Yes, Jose Orozco. I am remiss. I did not even mention that. I know this is an inflation stream, so we're not going to spend too much time on this one. But I did have that one queued up, Jose. That was a nice segue. Thank you. FTX founder Sam Bankman-Fried was arrested last night. It hit the tape around 7 o'clock p.m. last night. He was arrested in the Bahamas pending extradition to the United States because he has been charged with several crimes, things that are already a crime, things like wire fraud, bank fraud, a whole litany of things. And, well, let's just hope they don't put him in the same cell that they had Jeffrey Epstein in. At least not before he gets a chance to talk a little bit. Thank you very much, Jose Orozco, for the super chat and for the support of the channel, sir. I appreciate it very much. EC660 is here. He says, I'm here. You can start it up, boys. Yes, EC, you caught me on a live stream. This is an actual live stream, buddy. EC660 is known to drop those in, not realizing it's a premiere, not a live stream, or just at the very end, just missing it. So, yes, you caught us here in time. Thank you very much, sir, for the support of the channel and for everything you do. And I've got my man, .com. It doesn't show up. Let's see what .com sent. He said, for some reason, StreamYard doesn't show the super stickers on screen, but it's a hippo saying, get up. Get up. That was me this morning. Thank you very much, .com. I appreciate it.
Good.
What was that now?
It says get good.
Get good, get up. Yeah, man. I got to get moving. It is too early for me. But Freedom for All says, can anyone show me where the Constitution was ratified to allow fiat currency? Ooh, constitutional crisis. I am told, I don't know exactly what line or what section it in, but I'm told silver is actually, or silver and gold are actually constitutionalized as money. Hence the term constitutional silver when you go and you ask for pre 64 nickels, dimes, or I'm sorry, dimes and quarters. The nickels, I think, only had silver during the war, right? They called them war nickels.
Yeah, and everyone hates war nickels. So
Yep. By the way, I'm also told don't call it constitutional at the coin shop. Is that true, Mish? You spend more time at
that is
LCS than I
true.
do.
So what the a lot of the coin dealers will call it junk silver and not constitutional silver because technically it's no longer constitutional silver because it's not being put out by the Constitution. And that changed probably somewhere in the 1880s.
Interesting. All right. Well, thank you, Freedom for All. Appreciate the super chat in the morning. And thank you, Mike Binder from Robin RC Models. Says it's frustrating that JPOW and the CPI tell us how the economy should behave in the coming year. They can forecast the weather a month out, by the way. You know, it is hard. It's hard to forecast economic activity because the Fed is always driving in the rearview mirror, to use an overused pun these days. Not a pun, I don't know. Acronym, what's the word? Analogy. It's early. Give me a break, folks. It's early. They look at data on the previous few months' performance, and then they try to make decisions going forward, right? It's like looking in the rearview mirror at what's behind you and trying to make course corrections to make sure you don't run into a wall. You need to see the wall coming, not look behind you and say, well, I didn't hit them all or didn't hit a wall 5 minutes ago. I guess I'm doing the right thing. So it is hard to forecast economic activity. Although, let's be honest, when they started printing $6 or $7 trillion back in 2020, you anybody could have predicted this inflation, right? They fed us that BS line of transitory all last year. We all knew that was BS. We all knew inflation was coming. And then when it got here, everybody acted surprised. Oh my God, how did we get here? You know, you've got these guys like Robert Reek, economist Robert Reek, is saying inflation is because of greedy corporations raising prices. Oh, really, Robert? Is that why we got inflation? All these companies, they're suddenly greedy. They weren't greedy in 2019. Now they are. No, because of monetary expansion, folks. Monetary expansion. They printed money and prices went up. Happens every time. What the surprise is, I don't know. But it looks like now at least some of that has filtered through. Now, what's going on right now with the increases in interest rates and the quantitative tightening in the Fed, they have contracted the money supply and money is becoming more scarce. And so the price of money is rising. The price of money is interest rates. It's starting to hurt companies. Companies are starting to lay people off very slowly, but it is beginning. And so people have less money to spend, less money chasing the same amount of goods and services. We're seeing prices starting to come down. And we're now about 6 minutes out from that. Thank you very much, Mike, by the way, sir, for the super chat. You are a gentleman and a scholar. And let's talk a little bit about some of the big categories that are coming up, right? Energy has been the big one this year.
Hey, I think before we get too far into that, Jack, let's go
Yeah.
ahead and put out what we think.
Sure.
So I think
I'm at
I'm going to be at
7.6.
7.5 headline number. I think 6.3 is a core number, and there's several reasons why. But go ahead, Jack.
All right. I'm going to go 7.6 just to be difficult, Mish, because I think we're probably there for the same reasons, but I'm, just got to go a little bit higher. I'll go with 0.5 on the core or on the month over month number. And then my core inflation, I'll stick around 6.3. That's kind of a random number generator. The one thing I think might surprise a little bit is a year ago with the energy prices, we had a big dip. If you remember, right around the time the Omicron variant came out, we had a big dip in oil and gasoline prices last November. And so the number we're comparing to year over year is going to be a little bit lower this time around. I haven't heard anybody address that in their forecast. So you have to keep in mind, you got to look back at the base effect and what that might do. And that's why I'm a little bit higher. I think the energy number, even though energy costs came down in November a little bit, we're comparing to last November when they were much lower. So I think that could give us a slightly higher number. And another thing we got to keep an eye on, we've still got owner's equivalent rent. The the rents were never allowed to rise as much as they actually rose in the marketplace. Most cities across the country saw something to the tune of a 25% annual rent increase across 2022, even though owner's equivalent rent, let's go to the previous report. What was the shelter index? The shelter index rose 0.5%, I'm sorry, 0.8% month over month and 6.9% year over year. So there's still a lot of increases in shelter costs that have not filtered into the CPI math, even though those increases are not happening anymore. The rent market has stopped going up, but the CPI has not yet reflected prior increases. So I still think we're still looking at higher numbers for shelter. Now, some of the
OER lags 6 to 9 months, so we don't know exactly where that lag is, and we are just now coming into the big ramp. We're coming up the ramp. The people on the other side, so
you can kind of see that as these month over month numbers going back the last few. You know, we got 0.5, 0.6, 0.6, 0.5, right? That was kind of your bouncing around 5, 6 over the summer. Now here we are 0.7, 0.7, 0.8. So we have started to see that uptick in shelter. And I would add that the shelter index combined is about a third of all of the math that goes into CPI. Owner's equivalent rent within the shelter index accounts for almost a quarter of the CPI math. So this is a big one. A small tick up in the shelter index will have a very significant impact on the overall index. So that's a big one to watch. That's one that is still going up. And I would add that food inflation continues to rise. Food inflation right now, the overall food index is at 7.7 year over year. I'm sorry, that was the headline number. Food inflation is at 10.9 year over year. Now, within that, food at home, i.e. the grocery store, 12.4% year over year increase. Now, that's the one that, you know, rent and food, that disproportionately affects the poor and the working class, because that's most of the people in the lower income brackets, that is almost all of their budget right there is food and rent. And to see that one, excuse me, to see that one still so high, that is people at the lower end of the income scale still getting hit the hardest. All right. Now, you also have energy, which is another big input to people's monthly budgets. That one is still at 17.6% year over year. So energy, although costs have somewhat leveled off, the dumping of the SPR and everything has really cooled off energy prices, as well as forecasts for a recession. Those have cooled off energy prices, but still really hitting people where it hurts. Let's put it that way. And real fast, I have to send one more shout out. We've got about 2 minutes before the actual index hits the air. We've got Cormac Kilroy. Thank you, Cormac. He says, Jack, sent you an email on the FINRA fraud at MMTLP. I did get that one, Cormac. Thank you for sending that. Absolutely short squeeze, and FINRA halted trading with 2 days to cover. Could you please look into it? I have heard rumors of this. I haven't had a chance to do a DD on it. I'll look at that one, Cormac. Thank you very much, sir, for the super chat and for the tip on that one.
Yeah,
I'm not familiar.
FINRA.
What's that?
What is FINRA?
FINRA, I believe, stands for Financial Regulatory Authority. They're money cops. And I correct me if I'm wrong, but I believe FINRA is International Money Cops. I have to verify that one.
All right, wonder a minute. I think everybody in the chat needs to put in their guess real quick, just so we know. But we're less than a minute now.
And thank you again, Cormac. I appreciate that. So let's see your guesses, folks. Let us know what they are. I am going to queue up the BLS website. We are 1 minute out. Again, market is expecting 7.3 year over year headline and 0.3 month over month. Those are the numbers that will drive the market. Real quick before it comes out, right now markets are looking pretty good. I just saw a big green candle. Does that mean the number is out yet? It still hasn't hit the tape.
There's front runners. I've noticed that recently. People try to front run the number now.
All right. Well, I am refreshing like a madman right now, waiting for it to show up on the BLS website. They usually do it within a couple of seconds of 8:30.
Futures are up 850 points this morning already.
850. All right, so somebody got wind of a low CPI print. Here we go, and it is low. All right, the consumer price index for all urban consumers rose 0.1%. That's your month over month in November on a seasonally adjusted basis after increasing 0.4% in October. The US BLS reported today over the last 12 months, the all items index increased 7.1% before seasonal adjustment. So 7.1, that is the big number. Wow, market is going to like that. And Mish, you said futures were up. Boy, are they up. Currently up 817 points, although they're giving back some of it right now. But big jump there on that news. That is a pretty significant number. 7.1. That's, we were, what was it, just 3 months ago, 4 months ago, we were at 9.1. So that's a pretty big drop here. 7.1. The index for shelter was by far the largest contributor. That's what we were just talking about, to the monthly all items increase, more than offsetting decreases in the energy indexes. The food index increased 0.5% over the month, with food at home also rising 0.5%. The energy index decreased by 1.6% over the month, as the gasoline index, the natural gas index, and the electricity index all declined. All right, let's go to the numbers grid here, and let's zoom in a little bit so you guys can see a little better. So here we go. There is your headline number, 7.1% for the all items index. Food still 10.6%. That's still a pretty high overall number for food. Food at home, 12%. That's your grocery store, after 0.5% month over month. Food away from home, 8.5%. That's your restaurant food, up 0.5% month over month. That's down compared to prior months. And when I say down, that means a lower increase. It's still up. The price is still up. Here's the surprise here. Energy index, 13.1% year over year, with a negative 1.6% month over month number. So much for my theory about the base effect taking energy numbers higher. So we've got 12.2% on energy commodities, 2%, negative 2% month over month. Gasoline was 10.1% year over year, down 2% for the month. Fuel oil, that's the one that basically your diesel, that one, 65.7% increase year over year, still up 1.7% month over month. So fuel oil has not budged. That is staying stubbornly high. Let's see. Energy services, 14.2. Electricity, 13.7. And piped gas service, 15.5. So those numbers are roughly in line with prior months. All items less food and energy, that's your core inflation number, came in at 6%. That's slightly lower also. Market was expecting 6.1% and 0.2% month over month. So that was interesting. New vehicles. Oh, here's a big one. Look at the new vehicle prices. 0.0 month over month for new vehicles. That's interesting. I had Eric from Above My Pay Grade on my channel earlier this week, or late last week, and we were talking about used vehicles, which you can see that just in the one below. Used vehicles have come down, now down 3.3% year over year and negative 2.9% month over month. But this is the first time I've seen a zero print for new vehicles. Remember, we're just coming out of this chip shortage. Realistically, I think there's probably still a little bit of the effects of the chip shortage in the car market, but people just can't afford new cars, and it's finally showing in the price. Moving down, apparel, 3.6% year over year, 0.2% for the month. Medical, 3.1%. Services, less energy services, 6.8%. Shelter index, 7.1%. Okay, this is interesting. The shelter number came in at 0.6 month over month. So that's actually a slight downtick.
Yeah, it was 0.8, right? Before?
Yeah, it was 0.8 in the prior month. So that's interesting. Transportation, 14.2, and medical care services, 4.4. Real quick, let me go to the owner's equivalent rent here. All right, so the owner's equivalent rent index rose 0.7%. That was the month over month. What was the year over year? That is the only mention of owner's equivalent rent at 0.7 month over month. All right, so headline number is lower than expected. That is the big takeaway. Let's see what the markets think of this.
While you're pulling up the markets, what we're seeing, and several people in chat, thank you, Freedom, he has a super chat that talks about this too.
Okay.
The markets are swinging wildly. I just watched the Dow futures go up by 100, down by 200 in a period of 2 minutes. The Dixie futures have a 103 handle. The markets are split on this.
Okay. I'm wondering what they're split on because any way you look at this, this is a low CPI print. I mean, lower than my expectations, lower than yours, lower than the market expectations. I mean, let's bring
Someone
up
has some
what
selling
you sent me,
pressure going
Mish.
on. I don't know if they're taking profits or what, but
Well, I mean, you've got a big bump, and we've got a Fed coming out tomorrow, so maybe people are looking at this jump and saying, "Let's get out while we can." You know, you've also got end of year tax loss selling, which is going to be an issue in December because you've got a lot of losses out there that people are going to book to get their taxable down before the end of the year. But look, anyway, you look at this, and thank you, Mish, for sending me this tweet from Zero Hedge earlier today. Every single bank was forecasting higher than this. You had a lot of 7.2s here: Barclays, Credit Suisse, Goldman Sachs, Bloomberg, Citigroup, Morgan Stanley, Wells Fargo, all calling for 7.2. HSBC, JP Morgan, and UBS calling for 7.3. SocGen and Bank of America 7.3, 7.4. So anyway, you look at this, lower than expected. I mean, this was a much lower, still high, historically speaking, right? 7.1 is higher than any inflation read going back 30 years if you take out most of 2022, but it shows we're continuing to drop in CPI.
and
Right
I
now
think
the
that's going to feed this narrative of a pivot. Folks, 50 points base point raise is not a pivot.
yes, it's still a hike. It is less of a hike, but up until this year, 50 basis points was the biggest interest rate increase in history,
Mm-hmm.
right? 75, what do we have, three consecutive or four consecutive 75-point hikes?
Four.
Those are the biggest hikes ever historically. So to see 50 and be like pivot, it's a little over eager.
Yeah.
All right.
So the market, I think the Dow futures are down 300 points in 7 minutes
So they're down 300 off their high, right?
off their high.
Uh,
Sorry, yeah,
yeah,
off
I'm looking right now. We're at the Dow futures are calling for an open of up 560 points, and to Mish's point, it was 800 and change a few moments ago. So we had an initial big reaction, big candle up. We're giving back some of that now. Again, I don't like to trade around CPI prints for just this reason because you get these violent swings. The Nasdaq, we're seeing a similar reaction right now. We're up 363 points in the Nasdaq. We're calling for about a 3.2% increase, and the S&P is up 88 points, or calling for a 2.2% increase. So markets are still reacting to this um, quite violently. Thank you, Freedom for All. Appreciate the super chat, sir, for pointing that one out. And he's saying wild swings in the 2-year yields. Okay, let's bring the 2-year up here
I
real
think he's
quick.
saying 10 and 2.
10 and 2. All right. I'm going to have to probably close an ad. Yeah, there it is. And candle charts. Oh, yeah. Big moves in the 2-year yield right now. Currently up 4 basis points. I'm sorry, 40. Yeah, 4 basis points at 4.44%. Let's look at the whole yield curve right now. We've got the 1 month is at 3.75, up 1 basis point. Most of the other stuff is down just a tick. The 2-year is up 4. The 10 is down 5. 20 down 6. Not a huge reaction on the yield curve, to be honest with you. It looks like the long end is down more than the short end. That's interesting that we would see that. You're seeing the inversion steepen. I wonder why the inversion would steepen on this news.
I think we
That's
talked
an
a little about that last night. I think this is more of a restructuring of debt than it is reaction to market. I think people
short-term debt.
they've been carrying this debt, the less than 1 year debt, and it's getting too expensive. I think that's why you see that huge spike at the 6 month and the 1 year is that people have that debt and they need to buy longer term debt to get lower interest rates.
All right. Well, thank you very much, Freedom for All. Appreciate the super chat, sir. And hello to Jesse B. Says, I love your content. Thank you, Jesse B, for the kind words in the super chat. He says, I want to know why no one is talking about 401ks. It's all about pensions, bonds, inflation. Nothing on the 401ks. Are they just kryptonite for central bankers or something? I don't think they're kryptonite. I tend to lump them all together, 401ks along with pensions. Not so much bonds. You know, pensions, IRAs, and 401ks, I tend to put them all into one lump sum. Most people don't get a lot of choice in their 401ks. They get a choice between a handful of funds. And so most people don't trade and don't really play these day to day swings. They're in their 60-40 portfolios. They have an allocation to bonds, an allocation to stocks, and that's pretty much it. It doesn't really change that much based on this information. So maybe that's why it doesn't get all that much attention, Jesse. Although I did see an article recently. I don't have it queued up right now. I'm not going to go searching for it. It'll take too long. But I saw an article last week that said hardship withdrawals from 401ks are, I don't remember if it was an all time high or rising at an alarming rate, what the exact language is, but they are up. People are dipping into their 401ks due to financial hardship. And, that's something I've been talking about a lot on this channel. There is one thing I can bring up real quick that goes along with this point, and this is consumer credit. All right, this is a chart of America's credit card bills, and let me just zoom in on the last couple of years here. Going back to 2020, to the beginning of the pandemic. Let me make it a little bigger here for you guys. All right, we had Americans got locked inside, so they paid down their credit card bills. They stayed down, and then in the middle of 2021, Americans started running up the credit card bills again. And they're still doing it. Look at this number rising right now, approaching $1 trillion. Right? Those credit cards are now getting maxed out. And not only are they getting maxed out, but the interest expense on those is rising. Credit cards is adjustable rate debt. So Americans have already maxed out their credit cards, or they're about to be maxed out, and now they're also drawing down their 401ks. People, we need to learn to live cheaper. All right? And that's all of us, even people watching my channel. If you're watching my channel, you're probably wealthier than the average person. You included. We all need to learn to tighten belts. We can't run up the credit cards and cash out the 401k to keep up with the Joneses. That is bad, bad, bad financial decision making. I'm sorry to wiggle my finger at people. I don't want to sound like an angry teacher lecturing the class, but times are tough, and during tough times, you need to adjust, right? We adapt to survive, folks. And, I'm kind of zeroing in on the 401ks, Jesse B, in your comment here. Life got more expensive, and we have not yet adjusted, and we need to do that. So thank you very much, Jesse B, for the super chat and for the segue. Again, 401ks, I don't really
got an anecdote here real quick. I was talking to a
Mish.
friend of mine about the economy and stock market stuff, and she looks me straight in the eye and says, "We're fine. We have 401ks." And I said, "Well, what do you think your 401k is invested in?" She goes, "We're not invested. We're in a 401k." So people don't understand that they take the money from your 401k and invest it.
Yeah. And most people probably don't even realize what they have in their 401k. Open up your 401k, folks. Look in the prospectus of the funds you're in. What are the top 15 holdings in those funds? And I'm willing to bet you might think you're diversified. Like, oh, I'm in 6 different mutual funds in my 401k. I'm fine. Open up the perspectives. I bet you the top 5 stocks in each one of those funds is the same company, which means you're not really diversified. You just own the same stock through different funds that are charging you different percentages to hold the stock on your behalf. So actually, most people don't actually open up their 401k and look at what's in there because, well, the company only gives me so many choices. I just check option 1, 2, and 3 instead of 4, 5, and 6. And presto, I'm diversified. Not really. Not if you really look up in there. But all right. Thank you, Jesse B. I appreciate the super chat, sir, very much for the support of the channel and for your thoughtful comment about 401ks. And what's going on to my man, Brian Zarb from thetechnicalchartist.com. Hello, Brian. It's good to see you. Check out Brian's website. That is thetechnicalchartist.com. And he says, check out the Dixie and the 10-year. All right, I got the Dixie chart up here. Let's take a look. Whoa, look at that drop in the Dixie. Hello, 104.1. All right, that is a big deal right there, folks, because I was just talking to Mish right before we started this. The DXY had been bouncing around this vitally important 105.7, 105.8 number. I'm sorry, 0.07 or 0.08 number. That was the previous low from August. Let me zoom out a year on the DXY chart here, and let me set this to 1-day candles. Give me a second here. This is a chart crime, I know. Come on, Jack. Oh, now I did it. Now I'm getting the swirly screen of death. Come on. You can do it, little buddy. Now, I broke it. I broke my Dixie chart. But suffice it to say, the dollar was at a critical technical level. It had just recently broken down below that level, and it was trying to make up its mind. Where does it want to go from there? And, well, we finally got our answer just now with this big breakdown in the DXY. Let me see if I can get this thing to show me a yearly chart. All right, investing.com is not playing nice in the sandbox today. Here we go. Give you a candle here. Now you can see it. Now we can see it. We are going to go right around this 105.0809 level. That's where we were back in August. There's that line that I just drew. I'll make it a little bit bigger so you guys can see it there. And I like to use red. All right, so you can see that level. And then let's also add the indicator of the moving average, because we also broke below the 200-day moving average on the DXY not too long ago. Set that to 200 days. All right, zoom out, get a couple more data points. There we go. All right, so now you can see here, we've got confirmation of the breakdown in the DXY off of this. Unless we suddenly reverse, but I don't expect that we're suddenly going to reverse and head right back above. But breaking below the 200-day moving average and then taking out that previous low from back in August, that is a major technical breakdown in the DXY. This is something we've been talking about on my Patreon Zoom calls every week, which we get together on Wednesday on Patreon. There's a link down in the description below should you feel so inclined. But we've been watching this level, right? The dollar breaking down. The dollar is the denominator in the price equation. So if the dollar gets lower, that means the value of the stocks is going higher. That means the value of commodities is going higher. Things like gold, silver, oil should go higher on a DXY breakdown. Speaking of commodities, have we even looked at commodities yet? Oh boy, there they go. Gold up 29 bucks, silver's up 67 cents, 2.87%. Oil's up $1.48. Oil's still down pretty low, though. We had a big breakdown in oil recently. But you get the point. What Brian is drawing your attention to here is that dollar chart, folks. That is very significant to see the DXY breaking down like that. So this is the market is saying a less aggressive Fed is coming. This is the market saying pivot. So, Brian, thank you very much, sir, for the super chat, for your fine chart work over at thetechnicalchartist.com. Also, check out Brian on Twitter. Brian, what was your at Twitter handle? Sorry, I don't know it off the top of my head. I am going to bring that one up. Where is Brian? You should come right up here. Oh, you were there a second ago. There he is. Oh, at Brian_Zarb. That is Brian on Twitter. He is an undiscovered gem on Twitter. Let me just say, his chart work is fantastic. He does a lot of this stuff. We trade messages on Twitter a lot. I get a lot of my technical analysis, a lot of my ideas from watching Brian along with a couple of other folks. So check him out on Twitter if you get a chance. Thank you again, Brian. I really appreciate the super chat, sir, and the support of the channel. And did I miss somebody else? I think there was someone else in there. Scrolling down. Oh, there he is. Mike is back. Hello, Mike. Mike says, weakest CPI print since September of 2021. The dump is postponed. It looks like it right now, Mike. It does. I thank you for that data point that this goes all the way back to September of 2021. And I would agree the dump is postponed by at least a day. Because keep in mind, we've got the FOMC tomorrow. All right, so, yeah, like the Dow is up, looks like 730 points right now, pre-market. Dow's looking to open 2.1% higher. S&P 112 points or 2.8% higher. NASDAQ 450 points higher pre-market right now, looking to open almost 4% higher. So, yeah, I would say the dump is definitely postponed here, Mike, by at least a day, because Jerome Powell can come out tomorrow and say 75 basis points. He won't, but he could. Or he could come out and say, you know what, we're going to stay at 50 for a couple of months, which is more than the market is expecting, right? Jerome Powell could say something tomorrow and say, no, market, you got the wrong impression from this CPI print. Slap, 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 down we go, right? Jerome Powell has done that before. That's what he did at Jackson Hole back in August, and he set off that crash that we saw through the fall. All right, so market is postponed. The sell off, the big dump in the market is postponed by at least a day, maybe longer. But it's hard to see past a big event like Jerome Powell because a lot can change while Powell is talking. We've seen nearly 2,000 point swings just over the span of a press conference while Jerome Powell is talking. We've seen the markets go from down nearly 1,000 to up nearly 1,000 just in a few minutes while that guy was running his mouth. It's not how a free market is supposed to operate, but that's what we've seen. That's history. So, yep, I agree, Mike. It is a weaker than expected print. And if you're just joining us, 7.1 was the headline number. And the markets really like that right now, rallying hard on this news. Steve Woitis, thank you, Steve, says gold, silver commodities shooting higher on dollar weakness. Yes, sir, that is exactly what's happening. Check out my favorite of the shiny. Silver right now is up 73 cents. Let's look at a silver chart. I'd love to see this one. Look at that big, beautiful green candle on silver here. Up 70 cents right now, or 3%. Got a 24 handle. We'll see if that one holds. Man, I did not think we'd be seeing a 24 handle in silver this soon. I think we'll be seeing a 30 handle someday. But I thought we were heading lower before we went higher. But right now, 24.09. So the shiny is looking good, Steve, and gold is looking good also. Thank you very much, sir, for the super chat and your support of the channel. I appreciate that very much, guys. Am I caught up on everybody's supers? I am. All right. So, long story short, 7.1 headline number. What was it? 0.1 was the month over month number? What am I looking at here? No, this is the October number. Here we go. I knew that was wrong. Bear with me here. Okay, yeah. 7.1 headline number, 0.1 month over month headline number. Lower than expected. Markets are rallying. The dollar is down, which means virtually every asset class is going to be moving higher on this news. All right. Energy was lower than expected. Shelter was a little bit higher than expected. The core, all items less food and energy, that was also lower than expected, coming in at 6.0% and 0.2. The market was expecting 6.1% year over year and 0.3. All right. So this is any way you look at it from any angle, lighter than expected inflation read. Markets are going to like this because the market is going to be saying Jerome Powell is going to be going easy on us going forward. So that is the takeaway from this one. Mish, what do you think? You got anything I'm missing here? Any big numbers? I think you're muted, Mish.
Hey, I'm not muted anymore.
I
think you really did a really good job laying it out. I think OER coming down and the gas coming down is really what's driving this reading. And there's two narratives going on out right now. You have a pivot narrative that's going on, and then you have a narrative of, hey, 2022 was great, but that was just a preamble for what's coming in the second half of 2023. So I think we need to kind of keep an eye on that as a long-term goal also, that keep an eye on this information as it comes out, because Mr. Powell does not care about unemployment. He doesn't care if you lost your job, right? He's got two jobs. One, bring down inflation. He's working on that. He's not done yet. So that's still another 100 basis points. That is going to cause somewhere in the magnitude of 1 to 1.5 million job losses over the next 6 months. And leaning into a housing bubble pop, and you're going to have unemployment. Yeah, it's not shaping up to be a great second half of next year.
Yeah, I think the R word is we've seen a lot of use of the R word recently, recession. How deep and how severe, we don't know. We tend to be more on the bearish side here on this channel. I wear it right here on my sleeve, Perma Bear. I don't hide from it. And we're looking at job losses. We're already starting to see them tick up, but they're still very low historically. So we've got a long way to go. We're already starting to see the consumer is strapped. They're starting to, we had the one guy commented about the 401ks. That was an excellent comment. People are starting to cash in their 401ks. People are still running up their credit card debt. So a lot of this consumer behavior right now is not sustainable. And I think we're looking at a real shock to the system next year. I think the Christmas shopping season, we've already seen things like layoffs at Amazon and furloughs at FedEx and collapses in freight rates that says people are not shopping like they've used to. So I think those things, those are going to be deflationary forces. A recession is very disinflationary or deflationary. At the same time, we've got winter is finally setting in Europe. My man Mike Bender from Open RC Models sent us some data points today about the natural gas levels over in Europe. We're going to take a look at those. It looks like the reality of the cold winter is first finally starting to settle in over in Europe. That's going to have some inflationary effect that will spill over into the States. We've got this long-term trend of reshoring. That's going to be inflationary in the future. And we've still got a Fed that is being very aggressive, even though it looks like there's a lot of optimism about what the Fed might do now. And there we go. There's a black cat on the screen. That's ominous enough for you.
There you go.
Mish's cat. So there's forces in opposite directions right now in the inflationary story, and it's still too early to tell which one is going to prevail. All right. So right now, though, inflation is coming down, and it's coming down hard. And before we go, I got to say thank you to Civil Guard K9 LLC. That is a great name. It says the monster under the bed is 31 trillion. That is the national debt. Is that the 31 trillion number? And 2 quadrillion in derivatives, which is at the very tippy top of Exeter's pyramid. These Fed narratives are running markets. And yeah, my sentiment is the same as yours with that little emoji at the end. This is not how free markets are supposed to operate based on what our financial royalty, we'll call them. Is that what the Fed is? They're like the financial kings. They're king makers anyway. They're the most powerful people in the world, and they're not elected. I can tell you that. So, yeah.
You also have that 60 to 100 trillion dollars of off-book credit swaps. That's just
the dollar swaps.
There.
Yeah. Yeah, we did a video about that last week. 80 trillion in Forex swaps, mostly short-term debt. You know. So, yeah, that's the story, folks. That's what I got for you. 7.1%. Thank you very much, K9 LLC, K9 Civil Guard. Did I get that? Civil Guard K9 LLC. I got the name right. Thank you for the super chat, sir. 7.1%. Headline year-over-year number, 0.1%. Headline month-over-month number, lower than expected. Markets are off to the races. We got markets open in 15 minutes. We're going to call it there before 9 o'clock. Mish, anything to add?
Hey, thanks to M&J today. She did a lot of work in chat. It was more than I could handle. So good job. Thank you very much.
Thank you, M&J. Appreciate that solid work. Thank you to all my blue wrenches who keep things neat and tidy in the chats. I know we had a lot of people on this stream, and it can be a daunting task to keep things in. Oh, my God, M&J. Yes. Yes. Hi, Mom and Dad. Man, you brought your A game today, M&J. Hi, Mom. Hi, Dad. I love you guys. Thank you for everything. I'm supposed to say that at the beginning of the stream, but I missed it. Oh, man, I am going to get an earful from Mom and Dad today. All right, guys, we're going to call it there. Thank you very much for all your super chats, your generosity. Thank you to Mish and my blue wrenches for the excellent work you guys do. Thank you to my Patreon supporters for preserving the independence of the channel and all of your support. Looking forward to talking to you guys tomorrow on our weekly Zoom call. And look for that live stream tomorrow for Jerome Powell's press conference after the FOMC. We get to do this all over again tomorrow afternoon. Until next time, live small and dream big.